Good afternoon and welcome to our webinar on internal financial control. How ready are you? Our presenter today is Professor Arif Ahmed, and I'll hand over to him in just a moment. But I'm just going to talk you very quickly through some housekeeping rules so that the afternoon goes smoothly. Um, the slides that you'll see today, as well as the entire recording of the webinar, will be available to you within a week. We will send you a link. We'll send you an email with links to our SlideShare page as well as our YouTube channel. So if for any reason you miss today or you find you have to suddenly leave for a meeting or something, an emergency, you won't miss the webinar. You'll be able to watch it again. At the end of the webinar, a post-webinar survey will pop up, and I just ask that you give it a couple of minutes of your time to give us some feedback on how we're doing. While you're listening to Professor Arif, you might have questions that pop up in your head, and you can type these into the question box, which you'll see at the bottom of your control panel. And right at the end, Professor Arif will give time to answer your questions. And that's all that I need to say to you. I'll hand you over now to Professor Arif. Thank you very much for being here.
Good afternoon, everybody, and welcome to this particular webinar. I'm very sure that all of us who have registered for this webinar understands the criticality of the subject that we are going to talk about. And that is why I can see people joining this seminar. What exactly are we going to talk about here? Are we going to talk about the importance of internal control? Oh, yes. But then all of you are convinced, already know how important it is. And that is the reason you have joined this particular webinar. What we would like to do is try to run this particular webinar in a manner where you can understand how comfortable are you, how ready are you with the internal control requirements. But why sudden internal control? Internal control has been there for ages, and you might have noticed a newfound interest in this. That has come primarily because a lot of emphasis is being put on internal control as a compliance issue by the regulators. And on top of it, if you are a risk management freak like I am, then the internal control has a direct relation with your risk profile. And the riskier you are, well, the regulators don't exactly like you. So they would want you either to bring up more capital that costs money, or they would like to tell you to pull up your socks and throw in some of the missives at you, which do not actually help you to retain your market status. Now, if you look at the internal control, the first thing that you must realize, and I'm sure you already do, that it's a process. Internal control is a process. It's not an input, it's not an output, it's not a result, it's not a function, it's a process. A process involving people, a process involving operations, a process involving reporting, process involving compliance, but overall it's a process. And the responsibility of bringing in the process lies entirely with the board of directors of the entity and executed by the management. So you see, the whole spirit, the whole ownership lies with the board of directors, meaning to say that internal control is a necessary, an extremely necessary part of your organizational management process, so much so that it must be owned by the board of directors. And why that? Because this process is designed to provide reasonable assurance regarding your achievement of objectives. So if this overseeing process is working fine, then we can rest assured that my organization is going to reach few objectives which are classified as operations, reporting and compliance. Under operations, one of my objectives should be being effective, other being efficient, and third one is to safeguard my assets. Now, effectiveness would mean a result orientation. Whether efficiency would talk about optimizing your input output ratio. So the effort you put in vis-a-vis the results you get, this would define your efficiency. The effectiveness would be defined by the relationship that your activities enjoy with the achievement of the objective. And safeguarding the asset, do you really need to speak on that? It's essentially the assets utilization of which gets you the revenue. Now, if I do not safeguard the asset, A, my revenue stream may go down, and on the other extreme hand, even my entire business sustainability may be impaired. For example, let's take certain soft assets. Let's talk about your intellectual property. Let us talk about the design. Let us talk about formulations by a pharmaceutical company. These assets needs to be protected, and the operations looks into safeguarding of these assets. In terms of reporting, my objective should be reliability, that it's correct. It says what the fact is. Timeliness, the user must have access to the report at the time when they need it. And my transparency, meaning that if the reports are hierarchical, that is, if there is a base data which is aggregated to a higher level report or reports, then the user of the top level report must be able to drill down to the lowest level to see how the process of consolidation or aggregation has taken place. Similarly, the people at the lower level must know exactly to what purpose the data has gone in. Finally comes compliance. Yes, the compliance is a major objective now, and you must have compliance with the regulatory environment. Look here, we are not talking about a regulatory authority one or two, but the entire environment that you may have. And as some of you would have noticed, that it is no longer your local regulator that defines the environment. You would also find international regulators not having a legal jurisdiction over you, but in terms of regulation, unless you are compliant with the regulation, your business cannot go international. You might have noticed some of the regulations in the finance industry which are which are used across various jurisdictions. For example, you can look into an act called FATCA, which talks about how the US taxpayers transferred to non-US countries are to be monitored. Now, one needs to be compliant to that, or otherwise there is a fine too. Forget about the local regulatory requirement in terms of your taxation, in terms of your production, in terms of your environment and everything. So internal control as a process allows us to have this assurance, gives us this assurance that the processes that we are running achieves their objective spelled over operations, reporting and compliance domain. You'd perhaps also be aware of a COSO 2013 has been released, and it talks about your being the whole framework being flexible and customizable. So no concept of one size fits all. Look into the broad principles. There are 17 of them, and you need to read through them on this COSO. And there are 5 areas over which these principles are described. And this would help you to specify the objective. This would help you to assess the risk. We will speak in a little details on them in a while, and also to deploy the control. They also addresses the objectives across the organization. The organization may be broken into divisions, your operating units, functional issues, and across each of those domain, each of those cross section of your organization, we will talk about, will define their objectives, specify them, assess the risks which could be deterrent to meeting those objectives, design and deploy controls so that those identified risks do not hamper our regular process so much so that we do not attain our objective. So as you can see, this is a major process. Objectives are specified, risks are identified, and appropriate controls are designed and deployed. Risks come between your achievement of the objectives, you and achievement of the objectives. Controls mitigates those risks and takes you through achievement of the objectives. In terms of risks, the various risks that you would have would include your fraud risk, and you might have noticed recently a great amount of effort and emphasis has been given by regulators around the world on fraud risk, compliance issues, and so many other issues that you may have. So the internal control is changing. The way we used to have internal control is changing. The concept of that the internal control is always an activity which is a necessary evil is changing. The framework for assessing effectiveness and usefulness of internal control is going through a metamorphosis. And now what we focus on, the reason behind these changes. Primarily, if you look into that, the immediate 2 points that comes into mind is enhanced risk assessment. What happens? Risk assessments classically were often conducted in silos, small, independent functional areas. So I would focus, a production would focus, what are the operational issues or manufacturing engineering issues that can come in way of achieving the production target. And that stopped there. Now, under the change environment, the marketing department would also have a look into this operational risk faced by the production department. Because unless the production is there, the marketing department will not be able to achieve their objective and also to meet the customer expectation. And if that is not met, your financial targets are not met. And if your financial targets are not met, your strategy has to be changed. The recognition of this risk flowing across one silo into the other is one of the major achievement of the modified, the new version of the internal control that we're talking about. And what's very important, the COSU says the entity should have approved risk management, risk assessment methodology, which takes into account the 17 principles. So I would see those 17 principles. If some of them are not applicable, we will not consider them. Those which are applicable, we'll talk it about, and we will design and get the risk assessment methodology focusing on each of those principles approved by the top, the board of directors. The other area where this internal control focus has been enhanced is the fraud risk assessment. From a backbencher to one of the major burning issues, the fraud risk assessment has actually come a long way in a very short time. And that's what has created a huge amount of skill deficit in the industry. So we, the internal controllers, need to pull up our socks and we need to look into not only the fraud that has taken place, but the consideration of the potential for fraud. So not only we look into the frauds through our regular control process, but we'd also look into what are the frauds and the likelihood of a fraud happening in our organization and relate them specifically to a process. The other area what the management has to consider is the risk of overriding the control. Think over it. Every business has to, at some point of time, take the decision whether a control must be overridden. And generally, the override of the controls are associated with business needs. So if there is a major business need and the control is slowing down achievement of the same, the management often overrides the control and say go ahead. To take a classical case of overriding the control. For example, you have a gate in your office in which you need to swipe your card. Now, if there is a major activity going on, for example, you're shifting a furniture, then you don't expect everybody to go and swipe their card. So at that point of time, what you do, you decide to override the control and keep those doors open. Now think over this. Now, if the doors are open, you are also inviting the risk of an outsider, an unauthorized person entering into that particular area. Now that's the risk. So if I override a control, what are the risks that I invite? This is something the management must consider. And then the board, or maybe the audit committee of the board, which is a part of the board, would oversee this assessment. So the spirit is, if the business needs something to be overridden, go ahead and override it. But know the consequences. Know what are the additional risk elements that this override is inviting in. These two, enhanced risk assessment and fraud risk assessment, are two major changes. The third major change that COSO 2013 framework brings around is additional consideration to your IT framework. Now, I do not think it is any longer a necessity to use a cliche like IT is important and no major function has been done with IT. I mean, I think we all know. I think half of you who are sitting at this webinar is having this thing on, and some of you are perhaps having a Bluetooth speaker tagged to your ear, and somebody right now looking into your handheld devices, sending mail, whatever. So you can see how well we are entrapped in this IT part of it, how critical IT has become. And unless the system fails, you don't recognize how important or how critical it was. So what we need to look into are the similar considerations of fraud, of control, of risk, and risk mitigation on our entire IT. Information system audit was there, still will be there, and that was one of the mitigants. But now the internal control focus is proactive, not only reactive. So what you would like to do whenever you're looking into a business function or changing a business function, designing a new one, look into the IT risk aspect. Look into them, look into the considerations for ensuring quality of information. It is obvious that the quality of the decision is dependent on the quality of the information. More so if my entire system is IT driven. So the information are stored in my IT system, retrieved, processed on my IT system, and the decision making to a great extent can also be automated. So unless the first block of the movement, that is the information, is a quality information. Whenever you talk about quality, if you remember, we spoke about it being correct, its timeliness, so that people can, and the transparency. So all these three must be looked into. The fourth area, which COSO 2013 framework very rightly recognizes, are the outsourced service provider. Outsourcing is almost now a standard way of doing business. So every business unit is creating or is depending on some other unit for certain critical functions which has been outsourced. The problem is the extent of control you can have in an internal process is never the same that you would have on an external process. I mean, look into the part. You can set up your entire IT security framework within your organization. But the moment you are sending an email or transferring a file which goes into your vendor's IT system to be carried to the other office of yours, the way that is being carried, the security system on this network is no longer under your control. So the focus is on oversight of the third party risk management to manage the resulting risks. Let me give an example. I have an arrangement with a vendor who said that my entire data processing turnaround time will be 30 hours. Now, there is a communication backbone which my vendor uses to supply me the data. If that communication backbone breaks down, I won't get the data. My vendor may say, yes, I have done it. I have completed it within 30 hours as is contracted for, but the data has not reached you, and that's none of my fault. While technically it may be correct that it's none of his fault, but from my viewpoint, I have not received the data, and whatever are the consequent liabilities, I am exposed to it. How do I take care of it? Can I transfer the risk to this third party service provider? Can I get somebody else to pay me a damage for this risk? You see, I do not have control over this risk. So the COSO 2013 framework talks about give attention and also the board's oversight of the third party risk management to manage the resulting risks. So now, the moment we appoint an outsourced service provider, we need to make an assessment of the additional risks or the new risks that we are bringing in. And then the management should consider how they are to be monitored. The board needs to decide on how those risks are to be, whether they are to be accepted or mitigated. In terms of the control environment, the focus is on a set of standard, process, and structure which will provide the basis for carrying out the control. Now, you may accept certain standard for a control. You may look into certain ISOs which would talk about the quality in delivering a service or some ANSI standard for your documentation, processes, and also your structure through which this particular process should move. So you have to recognize them, you have to set them up, and these are the basis for carrying out control. Standards is a benchmark. If I change the benchmark, the control that I would be running would also change. In a relaxed environment, if my tolerance level for error is great, then my control can be relaxed. If my tolerance level for error is minimal, then my control will have to be tightened up. What kind of processes I run around? These are all integral to my control design and deployment. And though sounding philosophical, but the integrity and ethical values of the organization takes a major role in defining this control environment. The tone at the top, the way the board wants their organization to be perceived by the users. There are organizations who would like to see that the users perceive them as efficient. Some of them like to see perceives them as honest. Somebody like them to be perceived as quality supplier. So once those perceptions are frozen and accepted by the top management, the standards or the code of conduct comes into play. And then what we require is to establishing the parameter which will enable the board to carry the governance oversight responsibility. Those parameters are internal benchmarks. Once I achieve those internal benchmark, I can expect that my external benchmark requirements, the need to fulfill them, the need to touch them have also been taken care of. So these responsibilities would include your hiring policies. What kind of people will you take in? What kind of reference we would need? Would I take up somebody from a competitor? Would I rehire a person after the person has resigned? What's my whistleblower policy? Do I protect somebody who identifies an unethical practice in the organization at whatever level the identifier or the person who has committed the offense may be in? My responsibilities, my authorities. Would there be a situation where I have appointed a vigilance officer, but I have not allowed the vigilance officer access to my information database? So theoretically, I have a vigilance system in place, but in reality, that is ineffective because they do not have adequate power. Are all my processes documented? Because unless I have a documented process, what do I benchmark my control functions against? So this documented process requirement are also mark of approval by the top management that yes, this is how it will work. Which leads us to the concept of risk, and allow me to discuss this for a while. Risk is classically defined as likelihood of a threat materializing and adversely affecting achievement of objective. Every objective that you set up depends on a set of conditions, assumptions. If any one of them is violated, deviates, then I may not be able to achieve my objective. The causes behind those violation or deviation are my risk factors. So once I identify the risk factors, that does not mean that I will not have my objectives achieved. The risk factors may or may not materialize. Let us consider rain. Is it likely to rain tomorrow? Now, if it rains tomorrow, we are expecting a major traffic disruption. And so the office attendance will be affected. Now, my objective is to see that work is done on time, and to achieve that objective, I need people to come into office. So, if it rains and the traffic gets disrupted, this objective will not be achieved. So, the likelihood of a threat, how likely it is to rain, how likely it is that we can have rain tomorrow. This likelihood of the threat, which is the rain, materializing and affecting, is the risk factor. So you can understand the risk is not an absolute statement, it is a probabilistic measure. So what we do, we talk about the probability, frequency, and exposure assessment. Probability meaning, is it how likely it is to happen? Frequency means if it happens, how frequently it is likely to happen? And exposure means when it happens, what kind of asset value of mine or what kind of loss exposure that I have. Now, once we do that, we would establish objective at different levels of the entity. At a certain level, we can define that my objective is to ensure that monetary loss because of mishandling of material should not exceed 5%. Now we have achieved the 5%. Now we find out what are the probable reasons why this material loss can occur. And we identify bad handling, bad weighment, improper storage, or threats, or maybe inundation or moisture. So once we have identified them, now we design the controls. So control could be a good accounting measure. The control could be automation of the stock movement. The control could also be bringing in dehumidifiers. So these are the controls that I would bring in there. Once I bring in the control, now I would look into the risk tolerance and my appetite, which means to what extent I can bear the loss. Let us consider if the average loss is around 5% of the total value, and I'm comfortable with a 5% loss, that is, the financial impact of the 5% loss is either transferred easily to my customers or absorbed easily by me. If that be the case, I will accept the risk. I will say, fair enough, I'll expose myself to the risk because at the worst, the risk is not going to affect me beyond a point which I can sustain, which I cannot sustain. And then overall, I would like to see whether those risk factors are remaining within my risk appetite or tolerance level. Let us say the maximum amount of loss an organization can take is $1 million. Now I expect average loss to be 5%. So 5% of is $1 million. If you compute back, it's a $20 million. So if your average inventory size is $20 million, you are within your risk appetite. Now consider that instead of a $20 million, your inventory size climbs up to $30 million. The 5% level still holds, but the 5% on $30 million leads you to $1.5 million, whereas your risk appetite is $1 million. So now this calls for action that either I reduce my exposure with that inventory, sell off the inventory, or else on the other side, I ensure that the triggers for the loss are well arrested. The process of risk assessment, it looks into the maturity of the amount. How much of money is there? The criticality of a particular process and materiality of that particular process may be related, may not be related. Monetarily, a very, very insignificant asset may become material for the process. So what we focus on is not the cost of that asset, but we focus on the loss that asset can bring about. Let me give you a simple example. The fuse in the power panel of the building. Now the cost of that particular fuse is insignificant. But if the fuse blows and is not replaced, my production stops. So though the cost of that particular fuse is minimal, is negligible, but the loss potential of that fuse is very high. So you try to focus on the materiality, looking into both the aspects. Generally, a large monetary transaction is material. Generally, high volume of transactions becomes material because despite their having a smaller ticket size, they have a potential of aggregating into a large, significant volume. And also, the impact on the key ratios or disclosures. Please note, the organization depends on a lot of stakeholders who reviews their financial statements, who reviews their financial announcements very closely. Now, if a particular incident changes one of such key ratios or forces us to give us a major disclosure, that can be material. Auditor's negative comment, auditor's qualification can be an example of one such disclosure. This disclosure would have a significant impact, though in terms of material value, it may be nothing or it may be negligible. Sorry. The complexity of the process. The more complex is the process, usually you see limited internal skill because the skill set is also rare. The process is complex, skill set is rare, and replacing the skill set becomes a major problem. And this generally leads to overriding of a lot of controls. If the process involves multiple data and personnel involvement, then again management of that particular process ends up being extremely complex. If they're highly technical in nature, again management of that becomes extremely complex. So if you look into the complexity of the process, in that case, the risk that you assess for them would also have a high loss potential. Please note, there's nothing called a high risk or low risk. It is either high likelihood of it happening or a low likelihood, and on the other hand, a high loss potential and a low loss potential. Look into the history of accounting adjustments to get an idea about the risk assessment. If you find there's too much of adjustments going on, there are too much of accounting errors, a lot of adjustments for the valuation, then please raise your risk assessment value to them. The organization, that particular aspect is risky. And also, you look into the propensity for change in your business processes or control. If a business process changes continuously, there's one way I do the job today, and the way changes after the next month, only to be changed again after 3 months. Now, in that case, the risk exposure goes up because the skill set again is generally not updated, and also the process do not get time to be stabilized. And once the processes change, the accounting system may also change. Let me give you an example. If I was selling through dealers, there's a one kind of accounting. And if I start selling through my agents or set up depots myself and sell through those depots, the accounting will also change. If the accounting changes, the corresponding controls must change. And under the risk assessment process, I must identify if the particular process has a propensity for change, then we should have more focus there. We should understand that the risk associated with that particular process is also high. As we said, one of the critical area that you need to focus on is the fraud risk. We need to consider various types of frauds. And this would look into fraudulent reporting, both financial and non-financial, misappropriation of funds, which is self-explanatory, acts not permitted by law. Please note, depending on the nature of that particular act, the organization may end up being responsible for an illegal act committed by their employee. And also, again repeat here, the management override of control. The more freedom the management enjoys to override controls, the greater is the potential for fraud there. And the assessment process, the fraud risk assessment process would look into the incentive and the pressure. How much would one gain by committing the fraud? And what kind of pressure would the person be in to commit that particular fraud? For example, this can be even very simple. A salesperson whose incentive is linked with his achievement of the target was given a very high sales target, which the salesperson knows is not feasible to achieve. So the salesperson starts forwarding the sales from the next period to the current period by giving certain consideration or a discount to that customer. Now here is the pressure. Here is the pressure to survive, and the fraud were committed because of that. In addition to the incentive to or pressure to commit a fraud, there must be an opportunity to commit a fraud. The controls that are in place must either be inefficient or non-functional so that a person can commit a fraud there and get away with that. So that's the opportunity aspect. And third very critical aspect is the attitude of the person who's committing the fraud and the process of rationalization. Generally, a fraudster would rationalize their own action and they would not consider that to be anything wrong. The common alibi would be the employer does not pay me adequately or they do not recognize my work, and that is why if I'm not loyal, if I'm not honest to my employer, there's nothing wrong in that. So one need to assess the attitude of those staff, and also if one can identify the process of rationalization therein. Excuse me. When you design the control activities, they are designed through policies and procedure. You cannot have an effective control process unless you have a policy for that. The policy gives an organizational justification to the control process, and they're treated as the management's directive to mitigate risk, and consequently carrying them out becomes easier. But when I design a control, I must look into what kind of controls I have. Broadly, you can classify the controls as preventive, detective, and corrective. But when you implement the control, we must first identify what kind of control I need. Do I need a preventive control? Do I need a detective control or a corrective control? You consider the classical case of a fire alarm. Contrary to many people believing like off the cuff, fire alarm is not a preventive control. Fire alarm is a detective control. So if you need a preventive control in place, it is not the fire alarm that should be put on there, but it is a sprinkler that should be put on there. So I must first understand, do I need a preventive or a detective or a corrective control? Having determined that, then we will design an appropriate control serving that need. And those controls could be the process of approval, authorization, process of verification, process of reconciliation, process of segregation of duties. This could be those controls appropriate for that particular objective. Control in IT environment, another major area. There are two kinds of controls there. One is a general control, which focuses broadly, it's kind of a hygiene factor, and they would be applicable across all organizations. They would talk about access security. They would talk about system change control, whether and how one can change the system. They're talking about your data center and network operations, but these are general controls. And then you can have an application control which are married to specific applications. And they would broadly include your transaction control to ensure accuracy, completeness, and validity of each transaction through that particular application. So you have a general control and you have an application control. And you can conduct an information system audit to assess adherence to this general and application control in your IT environment. You may design your own checklist. There are checklists available in the market. You can pick them up and use them for conducting the systems audit. Information and communication plays a very major role is because unless the information is communicated, the very purpose of creating them is lost, is defeated. But if you look at the information system, that's also nothing a single person work. It's a set of activities which involves large number of people, processes, data, and technology. So that's complex. And because it is complex, we need to maintain their accountability. We need to measure and review their performance in terms of my information and communication. And we also see the process that would enable the entity to obtain, generate, use, and communicate the transaction and information. So if you look at it, not only an information system audit, but information system audit which is specifically focused on achievement of those goals must be initiated in the organization. And then comes communication of or how I share those information. Excuse me. When we are designing and implementing the internal control, we need to communicate with people, share information. They become handy, they're necessary to have a successful designing or implementation. So when I talk about the entire designing of the internal control system, we must focus on to whom are we communicating, to whom we need to communicate, to whom we should not communicate, what information should go, what information should not go to certain section of people. Unless we are able to achieve this, the particular control system may not work efficiently. For example, if the overriding mechanism that is supposed to be known on a senior level is available to a junior level officer, then an overriding can take place even at the junior level, though that was not designed for. And the quality of the information would depend on its accessibility. Do you get it when you need it? Correctness. Are you getting the right kind of data, the correct data? Are those data current? Are they protected from unauthorized use? Are they retained for subsequent reuse? Are they sufficient to take the decision? Are they available timely in terms of my need? Are they valid? And whether they're verifiable, that we can look back and check on that. We need to monitor also. We need to monitor whether the components of internal control are present and functioning. You see, on one hand, the internal control is designed and then they are deployed. So I can have perhaps a designing error, or I can also have a deployment error. So you need to look into it. It's a process of ongoing evaluation which must be built into the business process, which would continuously see whether internal controls are present and functioning. If necessary, on critical issues, if necessary, on critical processes, you may conduct such exercise periodically. So what are my focus areas for internal control? If you look into that, look into this chart and you get all those 17 principles given to you over the 5 domains. Under control environment, the system must demonstrate commitment to integrity and ethical value, exercise oversight responsibility, and a host of them mentioned there. In sub-risk assessment, I specify the suitable objective, identify the risk, and explicitly, I repeat again, explicitly mention assess fraud risk. So in the risk assessment, I will be looking into all kinds of risk with special focus on fraud risk. Similarly, on control activity, the process of development and selection and how they are deployed. We also look into information and communication using our relevant information in terms of internal and external communication. And then finally, monitoring those activities to see whether my controls are functioning correctly, and if they're not functioning, what are the steps that I need to take and whether I have taken those steps. So now go back to your desk, pick up the list of processes that you have, look into the various departments and functions in your organization, and then identify specific objectives there. Identify risk factors in the specific domain to see of what can prevent achievement of those 17 objectives, the 17 principles that we have given you here. And once you do that, I can assure you, you would have a lovely working internal control in a department. And this is where I would stop and I would look out for questions that you may have. Right. One of the very popular questions that I generally get is in terms of whether you have a standardized template for conducting information system audit. Yes, you do. In fact, there are a few books available or few principles available. COBIT is a lovely guideline for you. You can design your own internal questionnaire, which is COBIT compliant, and conduct a study on that. Other one, there's a book which is co-authored by myself, which talks about information system audit. It gives you checklists across 40 domains, all questions and all audit questions which are to be answered as yes or no, and you get a value for it, you get a risk score for it. So you can use that particular checklist for your various departments, run that audit, and give a risk rating to that particular department. If you Google up using my name and information system audit book, you should be able to identify that. The other area which comes around is how effective an internal control system can really be? Well, I have mentioned right at the beginning that the responsibility of having an efficient internal control system lies with the board of directors. So the board of directors must set the tone at the top, and the board of directors must be honest to the ethical requirement of this particular function. Unless there is adequate support from the top, no internal control system can act properly, can be designed properly, and implemented properly. So the internal control system, even if it is designed properly, ends up being implemented extremely poorly. In terms of the role of audit committee, well, audit committee is of course a major organ of the board. So when you're talking about whatever the responsibilities of the boards there, the these responsibilities are actually delivered by the audit committee. Now, do I need an internal auditor having a dotted line with the audit committee? Well, my view is yes. The head of the internal audit must have a dotted line with the audit committee so that if the head of the internal audit has identified some errors with the seniors, they should not be required to go through the classical organization hierarchy, and the red flag may be raised immediately with the seniors. Right? Is there any other questions that one would like to be responded to? In fact, internal control, if you look at it, is becoming a very exciting career option. You look into the European world and you'd find that the regulatory requirement of having your internal control process certified is increasing. So my recommendation would be use the internal control deployment in your own organization as an excellent learning ground. The organization benefits, as an individual, the practitioners also benefit, and at the end of the road, the profession and the economy as a whole benefits. Please remember the first point, internal control is the first step of reducing loss. If charity must begin at home, so should internal control. No outsider can be held responsible or can be given the responsibility of arresting losses arising out of your control failure. It's an internal issue, and it is the internal control department who must lead this particular challenge. Thank you very much for your time. A copy of this will be available as was spoken by the hostess. Get down the copy. If you have any further question, feel free to email it to us. Thank you for your time. Bye bye. Have a good time.